very critical. Back to you in studio.
Right, Noah, thank you so much for that. Now, the taxation regime in the country will need to be thought through to avoid killing the manufacturing sector. These are the sentiments of manufacturers who now say the current regime could continue to stifle growth in the sector as consumers opt for cheaper imported goods. Jimmy Mbogo spoke to Akinyi Gikonyo, who is the Trade and Tax Advisor at the Kenya Association of Manufacturers, on the impact of excise tax on the final product.
Then excise taxes affect how manufacturers price their goods?
Well, I think manufacturers have so far and until now are absorbing the element of excise, of the taxes that are going in, because we are trying to juggle with if we bring it out or if we manufacture it and it's not being bought, then what happens? So what has happened is, if you look at the profit margins, they're coming down. Right? To a point where is it making any business sense? Okay? Because when excise comes in at the point of production and not at the point of consumption, then the manufacturer has to include it into that price. Right? And remember, why are we including it into that price? Remember, the manufacturers have to get financing. And financing isn't cheap in Kenya today. So all these impact on the final cost of the product.
All right, so can you talk about payroll taxes in the country and the effect that then that is having with the players within the manufacturing sector in as far as their workforce is concerned?
The payroll taxes. So we've got the payee, and I think we were all comfortable with the payee. Then we have the NHIF. Again, we are tinkering with this, so it's going to go up. Then we have got the housing levy. Again, this is going to come out of the employer and the employee. But we are trying to look at what impact is it going, the net impact it's going to have on the employees. The employee's income is going to be reduced based on this tax element. The employer has to then contribute more. Looking at the bigger business environment, we are getting to a point where the employer is also struggling now to pay all the employees. And because some of our products which we would have been selling to create that revenue which we would want to create is also dwindling because of the tax strategy, which sometimes appears not to have been thought through. Right? But we want to say that we believe somebody's thinking through, we only don't understand how it's coming through. But the minute this happens, then we are forced to shut down some lines. Remember, I told you that we are working from a customs union perspective. So it's not about Kenya. So if Uganda and Tanzania have more favorable environment to do business, then a lot of business is crossing the border. Okay? And they'll manufacture it and bring it into Kenya at zero tariff. Okay? So if they're manufacturing it and bringing it into Kenya at zero tariff, what it means is that we are going to shut down some of our lines because it's not making sense. We cannot in Tanzania because their tariffs are staying where they're supposed to be, and they don't have too much consumption tax going into the production costs. Okay? So what happens is when we start importing from Uganda and Tanzania, then we are shutting down some of our lines. We've even got to a point where some of our activity is shifting to these countries. Now, when that happens, it means that we don't then need all the employees. Okay? So which means we are actually exporting the jobs. All right? And back to what happens with the taxes, we can then not afford to keep all these workers and give them a decent package to take home. So what happens is they drop you and Akinyi, right? And keep one person so that they can then give him a decent pay, right? So what this means is we're actually losing, government is losing tax because the people are not working. We have to send them home, right? We are losing jobs for our people, probably creating for the next country. And even for us, our corporate tax then goes down because our production has reduced. So everything is reducing. Everything is taking a nosedive. And it's important that, we review that position. And that's why I'm saying I don't know the thinking of those who are advising policy. But if we look at what is going on, it appears that we are actually taking a nosedive.
Let's before we let you go, let's talk about the issue of international tax treaties, and particularly those that Kenya is a part of. Have you felt the impact of these international treaties that Kenya has entered into as manufacturers?
But if we're talking about the trading blocks, for purposes of manufacturing and trade, then I want to say yes, we have. If you look at the EAC, the objective was to grow East Africa, grow industry in East Africa. If you look at the statistics, you will find that our partners are growing, and we're happy with that. But you will find that Kenya appears to again be taking a nosedive. And I want to keep it as objective as possible, where we are saying our partners are growing because they are now able to produce by themselves, which is a good thing. And again, why Kenya would probably be stagnating, one of the reasons is because East Africa is all producing the same thing. We are all producing edible oil. We are all producing paper and paper products. We are all producing metal wire, right? We are all producing the same thing. So you find that we are then not trading within ourselves because everybody has what everybody needs to have.
All right, thank you so much for that, Jimmy. And that conversation will be going on in our Transform Kenya program today from 6